world stock markets have managed to post 2 or 3 days of continuous gains. If we take a look at the charts of the FTSE 100, we can see here the strong gains that have been posted this week. Interestingly, we began the week in a pretty negative sort of mood. The market had tested below 5,000 and actually below 4,900 on a temporary intraday basis. So it's pleasing to see that actually it recovered that fall fairly quickly, and how quickly we've recovered, getting towards close to the top end of the recent trading range that has been established since the beginning of August. This whippy trading conditions market, of course, is just purely being driven by any positive or negative news coming out of Europe, and this week there's been quite a bit of action taking place at the central bank level. In Europe, we have seen an unchanged position on interest rates. I think earlier in the week there was potential for interest rates to be reduced in Europe. That didn't come through, but what did come through was some very meaningful support to the banking industry, which is in its own financial crisis at the moment throughout Europe. So moves there to try and address any sort of short-term concerns has been helpful and approved by markets. Here in the UK, the Bank of England has established a further £75 billion of QE to help the economy. The indication by that is that the initial £200 billion of QE assisted the market's economic growth during a period where otherwise it would have headed further into recession. But they feel it's time now to increase that programme. It's 75 billion, with some estimates that I've seen that number ultimately could grow to a further 300 billion as and when required. Initially that money heads straight back into the banking system, buying government bonds off of banks. Really the key issue here is of course what the banks do with that cash, because at the moment the wholesale markets appear very much to have snarled up, and has led to other methods of getting money through to smaller businesses, as announced by George Osborne earlier in the week. So that's the FTSE. One chart that I think is worthy of bringing to the attention is the chart of the Irish 10-year bonds, really as an example of a country that has been through obviously an incredibly difficult phase. This was one of the first countries to enter into a crisis within the euro, and as this yield shows, as the crisis sort of built to a head, how yields rose to about 14%. But the way that the Irish economy is beginning to turn around through the austerity drive that has been seen there for the last few months, it's pleasing to note that yields are coming back very, very sharply. It's been commented upon more widely in the press at the moment as almost an example of what can happen with businesses if they can sort of work with the markets to redress the balance, which clearly got out of balance during the last few years. Now, one thing we're going to look at today is companies, because one of the fears that has taken place since August is that the delay to any resolution in Europe and the darkening mood that is affecting financial markets will start to be felt in business, that we will start to see the contraction in the economy. It's being felt very much at the front end in the high street, where early indications suggest that September has proved to be an incredibly difficult month for retailers, and a few charts we're going to show here are really evidence of how that is beginning to impact. This is the share price chart of Mothercare, one of the first retailers to warn that the significant weakness that they've seen in September is leading to a fairly radical downgrade in profit expectations for the group. I have seen profit expectations cut back from 28 million to just 3 million, which shows the operational gearing that it impacts on some retailers. And you can see there that whilst we would hope that many share prices have indicated a slower economic environment and started to build in the potential for earnings downgrades, the evidence here from Mothercare, with the share price nearly halving on that is that there could be some way to go for many businesses to de-risk the potential downgrades to come. Then they're not alone. We had another warning from Supergroup, which, in fairness to Supergroup, their argument for the profit warning was more relating to logistical matters rather than demand for the clothing. But again, any negative impact is being hit pretty hard on the balance sheet, and the share price. However, it's not all gloomy news, and I will highlight two others in the sector that, despite this negative frame of mind for consumer spending, still seem to be holding very strongly in these times. One is Next. I did take a look at Next, thinking that the share price is quite close to its 12-month high. And wondering whether or not that would come under any pressure for fears of a downgrade. But that share price does really appear to be holding very well at the moment, and I think that the view here is that Next is selling goods that are still required and at the cheaper end of the market, and that seems to be a more stable end of the market at the moment, and hence the share price has not come under any pressure. And also in the sector, it's worth commenting upon Tesco and Sainsbury, both reporting actually more robust results for the food retailing sector at the moment. And we've seen a very strong increase in the share price from oversold positions. So there's Tesco and of course Sainsbury there, both rallying off the lows. Final comment from me today relates to sterling. I still think currencies need to be kept very much at the forefront of people's minds, particularly with all of this central bank action that is taking place. We've seen a further QE programme that, of course, could have led to some instability in sterling. Sterling has been weak recently against the dollar, as evidenced by this chart here. We can see how it's been drifting over the course of the last six or 8 weeks. The major reason being a return to safe haven currencies, and the dollar's been a beneficiary of that. But I think it's pleasing to note that despite a sort of temporary dip down to about 152 level, sterling seems to have rallied, so that this QE programme at the moment seems to have been received in a fairly stable market.